All right. Well, good afternoon, everyone. Welcome to Stock Investing for Beginners. Uh, Happy to be here with you today. Hello to Eva and Scott Luck and Jay Richardson and Rojo and Wacky and everybody else that's here today. Life in the Fast Lane. Will speak truth. Thanks for being here today. Have Barb out there in the chat. If you have some questions, reach out to Barb. You can follow both of us on X.com at Scott Thompson CS or Barb Armstrong CS for some follow up to our webcasts. Um, Today, I want to talk about a topic that drove me crazy when I first started learning about investing and trading, and that's setting stop orders. When I first got started, I'll share some stories with you about some of the frustrations that I've had using stops, and then, some ideas of how to change that. That you've hopefully learned a little bit over the last several weeks and months with me here in this webcast. And so we'll go through that. But before we get started, let me go ahead and remind everybody that our webcast today is for informational purposes only. None of the stocks that we talk about, or strategies for that matter, should be seen as a recommendation for you individually. Schwab does not recommend the use of technical analysis as the sole means of investment research. We are using the Paper Money software platform. There are some significant differences between the Paper Money and the live accounts. We'll be talking about stop orders today, so there's no guarantee of execution of a stop order at or near the stop price, which is always kind of an interesting experience. Um, Remember, all investing involves risk, including the loss of your capital, and past performance is no guarantee of future results. So, as you know, we have 8 lessons that we taught several months ago. We went through these 8 lessons, and then each lesson or each webcast that we've done over the last now several months has been follow up on these 8 lessons, either talking about planning our trade, position sizing, managing the portfolio, and we've done a lot of that over these last several weeks and months. And today is basically the same thing. We're going to be talking about kind of that idea of managing a portfolio. But I did want to share with you a couple ideas and some slides now regarding stop orders and the different types of stops that one might use, and talk about those a little bit in context of our trading plan that we're using, that we affectionately call the two green arrow plan. So let me go ahead and jump in here first with our first slide, is just talking about the different types of stops. There's what we call a fixed stop. We'll give some details on each of these here in a moment. There's trailing stops, which, many people ask about trailing stops. And I've talked to, number of different investors and traders over the years. And most of them don't use a trailing stop the correct way. So we'll talk about that a little bit. I'll give you maybe some ideas just briefly today on when someone might consider the trailing stop. And then we also talk about technical stop orders, which is really how our two green arrow plan starts, is with a technical stop. But let me go ahead and go through these different types of stops with you. I want to talk after the slides. We'll go take a look at our open positions. We did get stopped out of NEE this last few days. We hit the stop, and it got filled fairly close to the stop order. But we'll take a look at that one, and then we'll take a look at, there's 4 other stocks that we have that have the 2 red arrows on them right now that might require a stop adjustment. So we'll talk about those, and then we'll look at a few new trades today. So again, welcome to everybody that's joining us. If you haven't subscribed to our channel, please do that. It's a great little pat on the back for me and Barb and everybody, all the other coaches. The information we share with you is free. So hopefully, if you find it helpful, we can get you to subscribe and also like the different videos that we do. So let's jump in here with fixed stops. The fixed stop is just what it sounds like. They break down into 2 types: dollars or percentages. I often will use just dollar stops, but like the idea of a fixed stop is you place a stop a specific dollar amount below the entry price, or a set percentage below the entry price. And there isn't really a right or wrong answer here, but what I want to do, I want you to have either your notes handy or chat this in. What is the initial purpose of the stop order? And there might be 3 or 4 answers that I'll accept here, but what's the initial purpose of the stop order? So I'll give you a chance to think about that as we go through these ideas here. So fixed stop, again, pretty simple. Dollar amount or a percent amount below the entry price. Then you have your trailing stops. Now, trailing stops are kind of interesting. Trailing stops are a self-adaptive stop that moves and tracks the price action. The way it works, and Kevin Horner talked about this a few days ago in one of his webcasts, is if you set a trailing stop, and you can do that as a percentage on Thinkorswim, and you can do that as a dollar amount on Thinkorswim as well. You can actually do it as a tick amount, which I'm not going to talk about, but you'll see in that trailing stop choice, you can choose ticks, which is the like when a trade happens, that's a tick. But the way a trailing stop works is that it'll set that stop below the highest intraday high that is achieved during the trading day. So like in this example, if we had a stop 10% below the entry price, let's say it starts off at 67.05, then if and when the stock makes a new high, that stop would be adjusted. Okay, so like if we made a new high at 75.25, that stop would raise up and be 10% below that new high price. And then it would stay at that level until you got another new high. So if it went up to 75.50, we'd get a little adjustment in the stop. And then if it runs up to $78, we'd get a little adjustment in the stop again. And that stop would stay fixed or trail at that highest high price until there's a new high price. And in this example, we show a new high at 80.50. And, that's where the stop would go. Now, you guys have talked here, answered my question. Many people are using that stop order as a method of protection. I see protect profit in there, limit losses, uh, capital preservation. Those are all correct answers. And but here's the answer that I want you to write down in your notes somewhere as an addition to those reasons. The stop in our two green arrow strategy, it's really sole purpose. Okay, there's a couple other secondary purposes, but the primary purpose of that stop order is to get us out of the stock if the trend changes. And that's an important concept to understand when you're setting a stop because, when I first got exposed to stop orders, I thought, oh, great, this is a great way to, protect my capital or limit my losses. And of course, we share the disclosure at the beginning of every webcast in our series here that there's no guarantee that that stop will trigger or get filled at that stop triggering price. So if I set a stop, for example, at 72.45 on this slide on the far right, if that stock were to gap over that and open up at $60 the next day, I'm not getting filled at 72.45. I'm getting filled closer probably to $60. So one of the mistakes, now again, put this in your notes somewhere, but one of the mistakes that people tend to make when they're setting stops is they tend to set the stop too close. Now, when I first started, the reason I set my stop too close or closer than I should have is I didn't really want to lose the amount that I was putting at risk. And so, you can kind of go through the math, right? If I buy 100 shares of something at $50 and I set a stop at $48, like $2 below that entry price, then essentially I'd be risking about $2 plus because the stop may not get filled at 48, could be lower, but $2 per share times 100. And so I made the mistake of adjusting the number of or where my stop was relative to my entry price rather than adjusting the number of shares that I bought. So that's a mistake that people tend to make is they put the stop too close to perhaps avoid losing too much on a trade rather than setting a stop effectively and buying fewer shares. Does that make sense? So, that was a hard lesson for me to learn, and it took me a long time to learn it. So if you can learn it from me today, to buy the appropriate number of shares and set the stop in a good place. And we'll talk about what makes a good place as we go through our examples today. All right. So there's the trailing stop and the stop order and some little nuances, hopefully, about the stop. If you're unfamiliar with stop orders, take my word for it. You'll want to learn some of these things we've just talked about. Now, the other type of stop of these three is that technical stop. And we refer to this as setting a stop using an indicator of sorts, in this case, a moving average. Our initial stop, now you guys can help me out again here, those of you that have been following me for any length of time more than about 3 or 4 weeks should know the answer to this. But where do we set our initial stop in the two green arrow plan? What's the rule that we use? Okay, and so as you guys think through that, a technical stop, a moving average is a trend following indicator that shows the average value of a security's price over a set period of time. That's what a moving average is, and we kind of use it to define the trend. We use it to as possible levels of support and resistance. Some moving averages, the stock will tend to get down near that moving average, and then people might start buying it again, and so it kind of looks like it's bouncing off the moving average. Just another little nuance here. The price action doesn't see the moving average and say, oh, we're getting close to that 50-day moving average. I better stop going down. That doesn't happen. But what happens is traders and people, you and me, we see the stock might be getting down near the moving average, and we think, oh, the last time it got down here, it went back up again. So maybe I'll buy down here because I don't want to miss it rallying up again, right? So, there's nothing inherently special about any moving average. It just does what it does. It plots the closing price over a set period of time. And so, what we do is we use a technical stop to set our first initial stop order, and that's 1%. Yeah, you can see Jimmy and Richardson and Olga, responding in here is we set that initial stop 1% below the 50 period moving average. All right, so those are the little slides I wanted to share with you. Now what I want to go do is take a look at this NEE trade that we got knocked out of here a couple days ago. All right, life in the fast lane says 2% below the moving average. That's actually a really common rule as well, and so is 3%. Those are some common rules, but in our webcast for our two green arrow plan, that initial stop is set 1% below the 50 period moving average. Now I'm going to shrink this down over here for a second. So NEE, this was a kind of an interesting trade. We got into NEE over here on the 26th of February, and our initial stop would have been 1% below that moving average. Now, in this case, it looks like on that day, let me change my cursor here a little bit. So on that day, when we were getting into that trade on the 26th, the moving average value was at 84.67. Now, how do I know that? Well, look right over here under studies on that day, and you'll see that 84.67 value in purple. Now, that's where the initial stop would have been. We bought this, in there probably around $90, maybe as high as $95. I don't remember what our purchase price was. But our initial stop was there about, let's just kind of say maybe about 8 to 9 to $10 away. So it was about 10% away from that purchase price. Now, what's our rule of thumb on moving or adjusting the stop? Well, so there's a couple ways you can look at this. You can say to yourself, well, if I get a new green arrow on the MACD, like right here, we had a green arrow after we got in, it went red, and then it turned green right here. This is on the 30th of March. Some traders and investors would just adjust their stop on that new buy signal day, provided that it made sense to do so. Now, as a new investor, it's like, well, what does make sense mean? Well, what would you say the trend was? If we bought this on the 26th with the hope and the anticipation of the stock continuing in that uptrend, what happened to the trend? Well, the trend just flattened out right here. So this is, again, this is a little nuance. The rule, okay, the rule allows us to move the stop on a new buy signal, but in this case where the trend had gone sideways, this would be an area where, a seasoned investor probably would not move the stop just yet. All right. And so they may watch it until it gives like a new breakout, which we got over here when it went above $95, $96 here. Essentially it looked like the trend was trying to resume again. And then what's the other stop adjustment rule? Well, The stop adjustment rule is if we get two red arrows, then we put the stop down below the low price of that second red arrow day, where, if that low's at 50 bucks, we'd set it 3% below that low. That's our rule of thumb. All right. So now in this case, we got two red arrows over here. And so there was our first stop adjustment that we could have made. And that low was at 90.58. Okay, and I'm going to take my calculator over here just to review this. 90.58 times 0.97. That stop would have been about 87.86. And I think that's where I've got this line drawn. So now this is another very important thing. When you're adjusting your stop, very first thing is after you set your initial stop, we don't ever lower the stop. Okay, that initial stop is the stop upon which we based our trade, our position sizing. And so generally speaking, people will not and should not lower that stop order because then it increases your risk. All right. Now, this over here, we got a stop rule that says let's put our stop at 87.86. What have I been teaching you over the last several months? When we get that stop adjustment rule figure, we should follow that up with one question. Does the stop make sense? And so what does that mean? Well, the purpose, if you remember a minute ago, I said the purpose of our stop in the two green arrow plan is to get us out of the trade when and if the trend changes. That's pretty much it. That's the primary reason. Now, it also allows us to limit our losses. So as we move the stop up, then we're limiting our losses. At some point, which I'll show you on one of these other stops that we have to adjust, at some point the stop goes above our purchase price, and then we're attempting to lock in some profits, again, understanding that the stop may not get filled at the stop price. But those are the secondary objectives in the two green arrow plan. Now, some people will use a stop in a short-term trading mechanism very differently, and Barb actually talks a lot about that in her webcast. But for our webcast, the initial stop is meant to help us position size our trade and get us out if the trend changes after we bought it. As we adjust the stop, the primary objective is still to keep us in the trend as long as it's possible, but get us out if the trend starts to change or changes, okay? And so that's where the stop went. We went up here. I didn't adjust it on the new buy signal. And for whatever reason, my chart's locked up here. Let me change this quick. All right. So, we got a red arrow here this day, and it went low enough to knock us out of the trade. It hit our stop, and we ended up with about a 30, I think it was a $35 loss on our essentially close to $500 investment. Okay. So we did get stopped out of NEE. Is there any questions on this one? Eva says NEE is allegedly buying Dominion. Will that acquisition be halted? Who knows? But good question. And it's good to know some of those things. This may have dropped because of that announcement. So now my question to you is, was this stop effective or not? Did it get us out of the trade with a trend change? And that probably is a little bit subjective, honestly. But the point is we broke what I would consider a fairly significant level of support. It closed below it. It certainly traded below it and knocked us out of the trade the next day. And I'll be honest with you, very frustrating. The next day it's above the stop out price, right? But again, that's pretty common where you'll get stopped out. The stock may go up for another day or two. But if the trend changes, and I would say that this trend has changed, it started to change when we made lower lows and lower highs here in the short term. But the point is I have no problem getting stopped out of NEE with what happened. I wanted to buy a stock that was uptrending at the time it was. I was hoping for the stock to make a higher low and a higher high and continue that nice uptrend. It didn't do that. It went sideways for several weeks. And now with the trend breaking support, it stopped me out. And that's kind of the whole deal, right? So that's what a stop is supposed to do. Okay. And so if you're finding that your stops and your own trading are extremely frustrating, then I would have you do a couple things. Number one, revisit your stop rule. Where are you setting that initial stop? Is it too close to the price action? Are you trading a volatile stock that makes it very difficult to set a real tight stop? And again, there are other reasons why someone might use a tight stop, but our investing plan, our sample investing plan is meant to try to buy and hold uptrending stocks until that trend changes. And if the trend changes, we're getting out. And that's basically what the stop did and does on NEE. All right. Now let's take a look at a couple other one here. Um, yeah, Jay Richardson, perfect attitude. Says, if I get stopped out, I happily move along because the stock didn't do what I thought it would. That's exactly the right way to think about a stop order. It's not how I thought about it in the beginning, but that's exactly the right way. All right, let's take a look at a couple others that have two red arrows. Now, APD, you can see that we bought over here on basically a little bit of a pullback. The moving average was rising. We set our initial stop down there probably about, well, let's shrink this back down. That initial stop would have been about 272.31. The stock trended up a little bit, and we got two red arrows a couple of days ago. And now let's go through the mechanics. Where would we set the stop here? Well, the low price that day was 292.50. If we take our calculator, 292.5 times 0.97, the stop is supposed to be at 283.72. Okay, now we get that stop, and I think I've drawn a line there, 283.72. The question we want to ask is, does that stop make sense? And this is what we're really asking. If it goes down and hits that stop, is that stop low enough that I want out, number one? Number two, has the trend started to change or changed significantly enough that I'm okay getting stopped out? And so in this case, the way that we check that is we go back and look at some previous lows. We had a low in the trend here on the 17th of April at 288. So that stop at what was it, 286, 283. If it goes down and hits that stop, we're already making a lower low. Now we came pretty close to it today. We came down to 285.46, did not get stopped out, still have this position on. But, if we get stopped out, now this is kind of the cool thing about this two green arrow plan. If the trend continues for a few months, it's possible that our stop might be above our purchase price. Let's go look at APD on the monitor tab here. So APD, we got in there at 280. It's trading at 289 today, and our stop, I think, is at 283. So our stop in this case is $3 above our purchase price, and barring a gap down, if we get stopped out, we'll actually have a profitable trade. Now, it's not going to be as profitable as it was if we sold it here at 307. And some of you may ask, well, why didn't we sell it at 307? Well, because that's not the plan. The plan is to try to ride this trend as long as we can. So in this case, pretty easy one. We looked at the previous support level and thought, we'll put the stop there. That makes sense. And I did move the stop today and adjusted up there to 283.72. If we get stopped out, we'll have a small profit unless it gaps over that stop. All right. So that's on APD. Another one that got red arrows is COP. Now, COPs in the energy sector, this sector has been struggling a little bit over the last little while. We got that first two red arrow signal over here, and I don't think we moved the stop up that close on that one. But we got another two red arrow signal over here, and I think that's where I moved the stop up on COP. The stop is at 111.08 right now. We've got pretty good support there, about 113.80. And this stop, again, this is kind of the nuances of setting a stop and letting the trend hopefully develop here is, if the stock continues sideways, I'm just going to draw a little bit of resistance right up here. Looks like we're hitting our head there about 128, let's call it. But if this stock stays in this channel and stays above our stop, I will stay in the trade based on our rule set. We don't really have any adjustments. Now, if you want to go see a really cool thing to start doing when it's trading in a channel and it starts hitting this resistance level, some of you already know this, But we have a webcast on Monday that Cameron teaches, and that I think Mike Fairborn's going to be taking over. But there are some strategies that you can use to maybe make money when the stock goes through these little pullbacks. Now, we don't talk about them in this class because it's stock investing for beginners, but we have some webcasts where you can check that out. So go check out our Monday afternoon webcast there right after the Trading with Technical Indicators by James Boyd. But again, for the stop order, we got a red arrow today. The MACD is actually still green, so technically that's not two red arrows. But I'm not going to be moving this stop on COP until the trend resumes, if it does. If it doesn't, and it starts breaking this support level, we'll get stopped out fairly quickly. And again, that's kind of the purpose, is if the trend changes to the downside, we're out. All right. All right. So let's see here. Just looking through some questions. Don't see there too much. All right, let's look at the next one. The next one on our list that had red arrows is this Dow. This one was very, very interesting to me. Okay, so let's go back here and let me change my cursor again. So back here on this day, we got in the trade back on the 22nd of January, somewhere between about $28 and $29, it looks like. Let's take a quick peek. So Dow 28.74 is our purchase price. The close today looks like it was about 36.20. And so we have a nice little profit on this trade. Okay, we're up about 25% on the purchase there. And so the question then is as well, did we have two red arrows? Well, if we zoom in here, let's do this. So we got two red arrows right there. Does everybody see that? The 7th of May, we had a red arrow on the MACD. We had a red arrow here. And so there's our first signal to adjust the stop. Now, again, mechanics, the low price is 36.86. So 36.86 times 0.97. The rule says to put the stop at 35.75. Okay. Now, if that rule says that, what are we supposed to ask? Does the stop make sense? Well, if I go back in time and I look at some of these low prices and I draw a support line in there like we've done, and I have support at 35.55, then I think to myself, well, do I want to get stopped out at 35.75? Does that satisfy the primary purpose of the stop, which is to get me out if the trend changes? And from my view, if we get stopped out above support, we're not getting stopped out because of the trend change. We're getting stopped out because we set our stop too tight. Okay, and I would do this over and over again when I first started, and it would drive me crazy because I get knocked out, support would hold, and then a month later, 3 months later, whatever, the stock is trended back up again, and I'm not in it anymore. I hate that. Okay, so if I got my rule that says put the stop at 35.75, but I obviously have some support at 35.55, then it wouldn't make sense to set the stop above that support level if my primary objective is to get out when and if the trend changes. Okay, so what could we do? Well, we could put our stop 3% below the support level. What I did, and I'm going to talk about that here in a second. What I've done or did, this stop has been there for a little while, but what I did is I put my stop at 34.45 and I just went 1% below this lowest low price at that support level. That's how I set the stop. If you want to, take those notes, that's what I'm doing. I'm seeing where support is and I'm thinking, okay, if it goes down and hits 34.45, there's a possibility. Sure, I saw Barb made a comment there. It might go down and pick us off, rally back up, close at 35.50, and then go back up again. That can happen. Just, the only way around that is to not use stops at all. And I've talked to many people where that's been problematic. But, in our rule set, what we're doing is we're following two red arrows. We get a rules, 3% below the low price that day. We ask, does that stop make sense? What we're asking is there support in the neighborhood of that stop? If there is, then it makes sense maybe to put the stop down below that support level. That might be 3% below that support level or 1% below the lowest low in that support zone. Those are probably pretty close. I didn't calculate this, but let's do that for fun here. 35.55 times 0.97 is 34.48. So 3% below this 35.55 support and 1% below the lowest low at support is about the same spot. We missed it by 3 pennies, right? So that's where the stop is now. Now, I do want to talk about this one because I think it's interesting is the stock's been trading sideways right here. Again, if you're following the rules exactly as they're written, and I think generally speaking, and you should follow the rules exactly as they're written. And what we're reviewing today is when it makes sense to maybe modify that rule a little bit because of some technical analysis. All right. But here's another two red arrow signal, right? The MACD was red, been red for a little while. We got a close above the moving average. It went green. Then here on the 18th, it went red again. And the rule says to put the stop 3% below that low price, which is at 37.89. And I think I calculated that one. That would say to put the stop here at 36, what is that? 36.72. Well, 36.72 seems to be where the last low is. So do I want to get stopped out if it goes below 36.72? Well, that's up to you. You know, because I saw that support at 35.55, and this is a longer term type of a investment or trade, hopefully long term, that was too close. Now, could we have done that? Absolutely. Would we have been okay with that? Well, let's go back and look again. Now, this is where you have to decide for yourself how you want to play this because obviously we would have been stopped out today at about 30, what was that? 36 and change, 36.72 with a purchase there about 29. You know, that's not a bad return on that stock for a few months, right? The other rule there, you know, could have put the stop at 35.55. That was, I think, going below some of these other lows. But again, the process is still the same. It's follow the rule, check the rule. Does it make sense to put the stop at that level? And ultimately, you have to decide for yourself. You know, if you follow the rule exactly, we would be out today with a profitable trade on Dow. Okay, and then put this in your notes. So important. After we get stopped out of something, anything, I do not want to hear you coming back to me 2, 3, 6 months later and saying, well, we used to own Dow, but now Dow's trading at $60, but we're not in it anymore. Our job, okay, after we get stopped out of something is to continue to watch this stock if it meets our criteria still for a new buy signal. And guess what? Most likely that new buy signal is going to be above our stop out price. Welcome to the market. That's just how it works. And I wish somebody pounded that into my head because there's so many stocks that I had back in, you know, what was it like? How long I've been doing this? So I started coaching in 2005, and you know, a lot of stocks got stopped out, and I didn't follow that rule. I was looking for other opportunities, but so many that stopped out early and then got back up into the trend, but I didn't continue to watch them. So put that in your notes. If we get stopped out of something, if the stock still meets your buy criteria, then your job as an investor and a trader is to get back into the trade if it meets another buy signal. Okay. Important to know. Okay. All right. Jay Richardson says, should never blame anybody for anything. It's self-directed. And Scott Luck, I really like that. It is rough on your psyche. It is. Now, so that's taking a look at Dow. We had one more that had the two red arrows. This is Target. You know, Target gave two red arrows back here. I think the low price that day was 117.67. So 117.67 times 0.97. That's our rule. 114.13. I think that's where the stop is. And why did I move the stop up to 114.13 like the rule said to do this time? Well, the most recent support level there looked like it was about 116.83. I made the judgment call saying, hey, if that goes down and hits our stop at 114.13, I'm okay getting knocked out. That's going to be enough of a trend change that I don't want to be in the trade anymore. Now, could someone have gone back over to this low on the 20th of March and said, well, I'm going to keep my stop down below 112.69? Absolutely. Okay. Nothing wrong with that at all. Right. But I saw this low here on the 14th of April as the last kind of the support zone. If it goes below that and hits my stop, so be it, we'll be out. we'll be losing a little bit less than we would have on our initial order because the stop's still below our purchase price, but that's really not a bad situation to be in. We've been position sizing our trades, investing up to $500 in our mock $10,000 beginning portfolio with the idea of not risking more than about $50 total per trade, meaning that if we got stopped out, our loss would be less than $50. Now, here's a really cool concept too, is if I get stopped out, I'm willing to lose $50. And I mean, really, you're really willing to lose $50. Like, yes, if I got stopped out tomorrow and lost 50 bucks, I'm perfectly okay with that. If I got a buy signal the next day, I'd be jumping all over that stock and get back in. You need to decide what that number is for you. But in our example, it's $50. And if I get stopped out of target at this point, again, provided it doesn't gap over my stop, but if I get stopped out there and I only lose $28 or $32, that's way better than $50 of loss, right? It's a mindset shift that says, hey, it didn't do what I thought. I think Jay Richardson said that earlier in our class. The trend didn't continue. Yeah. Well, if the trend doesn't continue, I want to employ my money somewhere else, is the idea, right? So if we get stopped out, so be it. And in this case, because we have adjusted our stop up a little bit, we're going to be losing less than if the trend had changed immediately after buying it. All right. So JJ saying, how do you make the sense of the arrow on top or bottom of the candle? Well, those are automatic, JJ. So for example, if the stock closes below the moving average, that's what generates the red arrow. And these are red and green, which are kind of some colorblind colors. So you may not see reds or greens here, might be just gray-ish. But the arrow on top pointing down means it closed below the moving average. These green arrows, or the ones pointing up, just mean the stock price has gone back above the moving average. So hopefully that's helpful there. All right. Um, we do have a 4-day week next week. All right. So those are the stocks that we had 4 red arrows, on our plan here. And we'll just do 2 quick example trades and then we'll be done. Using the 2 green arrows. Now, I didn't run a scan for this. I've been pleading with you over the last couple of weeks for you to go through the S&P 100 on your own, every single stock, just simply looking for 2 green arrows, okay? I found 2 stocks that had those today. Well, I actually found there's probably about 14 in the S&P 100 that have the 2 green arrows, but these 2 were the ones that I thought were either closest to the green arrow signals or they were doing something interesting on the chart. So Ford's the first one. Now, here's what I'm talking about regarding these stops. We bought Ford over here for the first time in our class on the 8th of January. If you remember that webcast, we saw the resistance there. I think we used what's called a buy stop order. So we said, hey, if it breaks out, then get me in. And we did. We got in there on the breakout. At the end of the day, we were up nicely, which is why we use a buy stop order. And then it came back down. Okay. We got 2 red arrows here on the 20th. Kind of jumped around a little bit, made a new high over here, and then it closed below the moving average. And we moved our stop because we got that. We got stopped out here and it gapped over our stop probably. And we lost a little more than we maybe expected to lose, but probably didn't lose more than our original. It would have been really close. Looks like it was a pretty close level there. Now this trend obviously changed. This is why we did the stop. If the trend changes, we don't want to be in there anymore. And the trend went down for several weeks, started bouncing around over here lately. We got 2 green arrows right there on that day. And the moving average does look like it was rising. So theoretically, at the end of the day, we could have bought it up there probably near the close and saw that moving average was rising. The stock rebroke that resistance, pulled back here into short-term little bull flag pattern. And today is what's called a bounce. Okay, so write this in your notes. Maybe it's not a bounce. Let me see for sure. Oh, technically it's not a bounce. Okay, so this is what a bullish bounce is. A bullish bounce is a close above the high of the low day. That's how we define a bullish bounce. Okay, this is our low day yesterday. The low is the low day. Why? Because it has the lowest intraday low. So whether it's a red or green candle, at least in my opinion, That's the low day. A bounce would constitute a close above the high of the low day, which is 1323. Today we traded above the high of the low day, but we didn't close above. So if you're a bounce trader, you may have gotten in intraday when it traded above 1323. If you were someone who waits for the close and says, well, that didn't close above the high of the low day, I'll wait to get in tomorrow. If you're using our two green arrow strategy, we have green arrow on the MACD, a green arrow on the moving average. The moving average is rising, so we can buy this. This is a valid buy signal on our sample investing plan. Okay. And so we're going to go ahead and place this trade. Now, from a psychic, or not psychic, but psychology standpoint, trading psychology, let me give you some other things to be aware of. Okay, put this in your notes somewhere. If we're getting in a trade below where we know we have a resistance area, just expect the stock to maybe wiggle around here, struggle a little bit to get through that. That's going to be kind of normal. All right. If it goes above this area here, call it 14 and a half, that's probably another area where we're going to see a little struggle. We're not going to concern ourselves with that. What we're seeing is, hey, it was downtrending. We're making some higher highs and higher lows. If this trend resumes and goes up nicely, I want to be in it. That's all we're saying. If it doesn't, it'll stop us out again. So let's go ahead. We're going to right click right here about the closing price, 1322. We're going to do a buy custom with stop. We're going to shrink that down there. We're going to notice our stop's going to go at 1208. So we'll put that in there first. So 1208 is just where our stop order is going to go. That's 1% below the moving average. Shrink this down over, well, let's do our math first. So 1322, if we invest up to $500, divide by 13.22, we could actually buy 37 shares. And in this case, we're going to do just a mental quick check. If I get in at 1322 and stopped out around 12, that's about $1.20 risk per share. Is that close to my $50 total risk? So I don't want to buy too many shares, I guess is what I'm saying. Okay. So it looks like we're okay with the 37 shares. Is that what it was? 500 divided by 1322. Yeah, 37 shares. So we'll go in with 37 shares. Then we're going to lock that link up so it's 37 buy, 37 sell. The entry price we're going to put there at 1322, the closing price. It'll be a limit order. I like to make them good till canceled. And then that's our trade here for our example. And we'll put that in our two green arrows. And, again, recognizing the stop may not get filled there, it could gap over. Say, send that order off. Now we have a working order. Now, it looks like we're out of time here to do the second trade. So I'm going to give you the symbol, and this is not a recommendation, but I would give it to you for homework, is MET. The trend started to resume again. We have fairly recent two green arrows, and this one is broken resistance. So for homework, this is the other example trade I wanted to do. I just, we're out of time here today. All right. So, but you can run the numbers in your own paper money accounts, figure out where that's going to go. As always, if you have some questions about anything, you can chat those in. You can also, if you're listening to the recording, you can put those questions in the YouTube comment section. I'll look for those every day. And if you have some questions in there, I'm happy to answer those as well. And so on the home page, if you want to go back and review those 8 lessons that we talked about earlier, just go down to Stock Investing Basics. This whole playlist is really just all these 8 lessons that we went there for the start. All right. So have a great weekend or a great week, everybody. Thank you for being here today. Hopefully this is helpful for you. If you have questions about a stop, please put those questions in the YouTube comments and I'll get to them. So have a great day, everybody. We'll see you.